Welcome back. I'm your host, Jessica Devereaux, coming to you from Baltimore. And we're continuing our conversation about the housing crash of 2008. We're joined now by our three guests. We have Richard Bowen, Michael Winston, and Bill Black. Thank you all for joining us, gentlemen.
Here.
Okay, so I really think it's important for folks to get their head around what happened in 2008. I know it can be very complicated. Bill has been on this program many times explaining it. But at the heart of this is something called mortgage-backed securities. Bill, can you just talk about what exactly mortgage-backed securities are and why was Wall Street so keen on pushing them?
Well, first, I don't think it actually is mortgage-backed securities. I think that's actually been overemphasized. I think it's mortgages. Even if the banks had held these things in portfolio, as they did in Ireland, for example, you can get massive bubbles and you can grow massively because you report record profits. But as in the first segment, Richard and Michael explained how two of the largest lenders in the world, the home lenders in the world, either originated or purchased loans that they knew were horrible. Now, that seems to make no sense, but under the fraud recipe, it makes enormous sense for the officers. So the institution will lose, the bank will suffer losses, but it's the people that are going to end up homeless and with their credit devastated. They come in all kinds of degrees of moral culpability. Some of them were folks who were professional investors. They owned 5 homes. They lied on all aspects of their applications. They're basically in it with the Mazzillos of the world. Very large group of folks. They go in, they have very little idea what's happening in the entire process, and they're skinned alive. And one of the ways of telling that is yield spread premium, which is where you get people to overpay for their mortgage interest rate, and the lender pays a kickback to the loan broker, who is able to fool the homeowners. Well, we know that New Century, for example, almost exactly half of the time, they were able to rip off their customers in that way. So culpability varies among the individuals, but in the C-suites, culpability runs deep.
Okay, well, there are going to be some folks, though, Bill, who are going to push back and say, yes, of course, culpability is in the C-suites, but at the end of the day, folks sign these contracts, and not understanding the language, for example, or not reading the contract is not a defense, and they should be held accountable for entering into these mortgage contracts. I want to get Michael in the conversation. So what do you make of that argument? Should folks have to pay for those consequences?
Yeah, I was deeply embedded inside Countrywide, and I saw all the tactics and techniques by which they duped people into signing things they didn't know. And by the way, Countrywide was a master at robo-signing stuff that was not signed by the mortgagee, and that had different terms and conditions. I saw, after a month-long trial against them, I saw documents show up that I knew weren't in existence before a judge requested them and said, if you have this, this would explain it. So they created something out of whole cloth. And if you look at Abigail Field's writings during that time, she wrote for the Wall Street Journal, you'll see that that out of thin air, they made stuff up. So I would say some estimable percentage of what was signed, what the borrower signed in real time looked nothing like what they had at the end. Mm. And so these people were magicians with bad intent.
Okay. Now, how can we avoid something like this happening in the future? Congress's answer has been Dodd-Frank, but has it really gone far enough? Richard, I'm going to bring you into the conversation. Do you feel like we are in a more secure position today than we were before the 2008 crash?
No, I don't. Absolutely, I don't. In the first place, there's been no accountability whatsoever. for what has happened. As a matter of fact, the government has bailed out the banks. There really is no downside for this. There is only upside, at least as far as what the banks understand. As far as Dodd-Frank, quite frankly, the large banks are systematically gutting those very provisions of Dodd-Frank that actually specifically relate to the large banks, leaving some of the provisions in there which are primarily applying to the smaller banks, and the cost of compliance of Dodd-Frank. And this is one of the ironic aspects of Dodd-Frank. It actually increases the cost of compliance so much for your smaller banks that it actually works to the benefit of the large banks.
Can we talk about those
Because
specific provisions, Richard, that are actually beneficial to the banks or not harming them?
Well, if you're talking about what has been gutted out of Dodd-Frank, for example,
Yes.
uh, well, for example, there was a prohibition in Dodd-Frank as it relates to basically derivatives that prohibited the large banks from funding derivatives, basically using the depositors, the government guaranteed depositors' money to gamble with derivatives. And in the year-end funding provision from 2014, they lobbied Congress and got Congress to insert provisions in that year-end provision that basically gut that provision and took it out, in essence, of Dodd-Frank. So again, and this was obviously the risky derivatives caused a great deal of losses, and there's no reason to believe that that isn't going to happen again. As a matter of fact, the derivatives position is significantly higher today than it has been previously. So there's just one specific example of how Dodd-Frank has truly been gutted.
All right. I want to turn to a specific case and talk about the state of Nevada. You know, everyone's talking about now because we have the caucus coming up on February 20th. So you can see that there are some visible scars in Nevada after the crash. Nevada actually has the highest monthly foreclosure rate in the U.S. from January 2007 to February 2012. They had the highest. And now, today, it has the fourth highest rate of foreclosures in the country. So since 2012, Wall Street firms have actually been buying up foreclosed properties, driving up the prices of the prices of these homes, and it's making it more costly for people to buy them, obviously. So, Bill, I want to ask you, what is the tactic behind doing a thing like that?
Well, let's again start with the tactic and build on what Michael said. This is one of those markets in Nevada in which that magic was done. So let me first quote Tom Miller, the longest-serving Attorney General in the United States of America for Iowa, who testified in front of the Federal Reserve, trying to get them to ban liars' loans, that their investigations found that most lies and liars' loans were introduced at the instigation of the lender. And I know people think this would never happen to them, but, one of the folks who works with us is Dr. Zimbardo, who is actually a high school classmate and close friend of the late Stanley Milgram, who did the famous obedience to authority experiments. And the key is, in truth, if you are told by someone in authority to put down a number, somewhere around 60% of human beings will do that, even when they have no stake. If in these circumstances, they actually have a stake, whether they get a home or not. And if the expert tells you to put down that number, in fact, most people do. And Michael is absolutely right. This was Six Sigma of fraud, where they tried and they tried and they tried and they looked at the results and they modified how they pitched it to people until they got the ideal form. And even then, as Michael said, they frequently manufactured the documents. And yes, to go to Nevada again, many Latinos, the loan broker would be having all the conversations in Spanish. The person buying the home would have very weak English. You get to the closing, all of the documents are in English and they are not translated, and they shove them in front of you and say, sign here, 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 here. And if you've been at a closing, they do that 75 times. And you just sign. All of us just sign.
Yeah, we do. It's true. But Bill, with Nevada, though, why buy the homes? Why not have the banks just say, we're going to put it up in the market and see what the market does with the home?
So there are a couple of things going on. The first thing that happened was a very long period of typically not foreclosing. And that was because the banks had the political juice to go to Congress with the tacit aid of the Obama administration, the explicit aid of the Chamber of Commerce, which is usually one of the most severe opponents of Obama, and the express wink and the nod of then Federal Reserve Chairman Ben Bernanke. And they extorted FASB, the Financial Accounting Standard Board, and the only thing they do is set accounting standards. And they said, we are going to remove that authority from you unless you change the accounting rules so that the banks don't have to recognize losses. So the first thing they tended to do for years was sit and let these properties deteriorate, become eyesores, become drug havens, mosquito, the pools, this is Nevada again, became the great mosquito and rat sources, vectors of the world. That makes the property really cheap, and at that point, you're basically being a vulture investor, and that's a niche in finance. They wait for things to be really distressed, and they buy. Now, when you buy big, so you're talking about buying 1,000, 2,000, 3,000 of these homes, it also, a bit like Dick was saying, you get some real economies. So it pays, for example, to attack your assessments. And so you drive down your assessments on your properties very substantially as well. Obviously, that has obvious advantages in terms of your carrying costs in all of this. And then, Nevada still is one of the states where more people move to retire to. So you still get in-migration and such, and you sell into the recovery and try to get a lot of money in that fashion.
All right. And there's a real fear really brewing that we're on the verge of another crisis with what you just described there, Bill, happening. And in particular, this targeting of low, quick loans, these commercials. I don't know if you guys watched the Super Bowl, but there was actually a commercial during the Super Bowl that was talking about rocket loans. And it was very reminiscent, at least to me, about the pre-2008 conditions, this sort of messaging behind getting quick mortgages. And I want to ask you, Michael, is this something that we should be really concerned about?
I'll give you a perspective that I think neither of my two colleagues can do. And that is the perspective of I was once a psychologist. And a tenet of psychology is that people will do that for which they are rewarded. They will not do that for which they are punished. Seems simple and basic. Actually, all the financials mastered this to a fare thee well. Because if people will continue to do that for which they are rewarded, what if bad behavior is rewarded? And what if good behavior is punished, which makes good behavior cease and desist over time? Well, we know that there hasn't been not one of the architects of the financial fraud that was rampant was even indicted, let alone prosecuted. Not one. So here are these guys, all of these banks are flusher, they have more head count, they're more profitable than they were before we bailed them out. So to them, they say, what's the downside of continuing to do this? A toothless government is not applying the rule of law to them. In prior administrations, people would say such rampant and such rampant and blatant fraud is against the law. And there are punishments, whatever the color of your collar, white collar, blue collar, it matters not. There are punishments for such fraud. instead, we hear members of the administration talk about, well, there was a lot of recklessness. I think there was no recklessness. I think everything that was done was strategic, specific, well learned. I think every lie that was told was well rehearsed and well practiced. And so, sure, since they're all bigger, wealthier, and have the tacit agreement of the government to do so again, why wouldn't they do so again? And they are.
And they are. Okay, we're going to leave it at that. Michael Winston, Richard Bowen, as well as Bill Black. Really, really great conversation. I certainly learned a lot. I hope our viewers did as well. Thank you all for joining us.
Thank you, Jessica.
Thank you.
And thank you for watching us on the Real News Network.